Hey guys, welcome back to Smart Wallet and Me, where financial wisdom really matters. A large portion of a successful investor is the ability for someone to control their mind and emotions. It isn't enough to just be able to read charts and financial statements, although that is very useful. In this video, I'm going to show you 3 psychological investing mistakes that are most common so that you could avoid them at all costs. So let's get into it. If you're new to my channel, please consider subscribing. And if you've already subscribed, I want to thank you and welcome back. The first thing that we're going to be talking about is fear of losing money in the stock market. A common psychological mistake in investing is the fear of investing itself. When investors suffer a major loss, as many did in 2008, the news of the crash takes headline news and makes people fearful to invest at all. I get it. Nobody wants to lose money. Nobody gets into the stock market with the intention of losing money. We all work very hard for our money and don't want to see our money vanish away by investing in stocks. This fear causes many people to watch from the sidelines, making them lose on some of the best investment opportunities out there. Another aspect of fear occurs when someone invests money in the stock market, and when their stock prices go down, fear grips them and they panic sell their stock in fear that they will lose even more money. They don't allow their stock the time to recover. In other words, this mistake causes a lot of people to buy high and sell low, instead of buying low and selling high. They allow their emotion of fear to dictate their decisions. They pull the trigger too quickly. All stocks go up and down. No stock just keeps going up in a straight line without a correction. The key is to know the major indicators and when to buy and when to get out. The second common mistake is something called the sunken cost trap. A sunken cost trap occurs when you keep holding on to your investments while they are sinking, while at the same time convincing yourself that they will go back up. You don't want to sell too quickly, like we discussed earlier, and you don't want to sell too late. It is truly hard to take a loss and or accept that you made the wrong choices or allowed someone else to make them for you. However, if your investment wasn't a good investment and is sinking fast, it would be better for you to sell it so you don't lose more money. Just be honest with yourself and humbly accept your losses and move on. Everybody makes mistakes and bad decisions, and not every trade that we make is going to make money. Overconfidence that is misplaced could lead to more losses. This false overconfidence makes them think that the bull market is going to last forever and that it will go back up very quickly. It is better to cut your losses than to keep bleeding and thinking that there's going to be another recovery and that the price is going to keep going up, when in actuality the price just keeps going down. If there's a major scandal at the company you have invested in, or there's a major market movement, don't be blind to these indicators. I unfortunately made this mistake back in 2017 when I purchased cryptocurrencies at their peak, and instead of selling them when they were going down, I kept convincing myself that Bitcoin was going to go back up to $50,000. If I had sold earlier, I could have cut my costs and bought again when they went down further. I got caught in the sunken cost trap. I know this is easier said than done for most people because we are dealing with people's emotions and money and the psychology of money. But if you avoid this psychological mistake, it could save you a lot of money. The third common psychological mistake in investing is greed. When an investment rises, there are always people trying to cash in to make a quick buck. They think this investment is going to make them rich, and they think this is the one, so they invest all their money into it thinking that they're going to make a lot of money in this investment. When enough investors get into a stock, this creates the stock price to usually go higher, and creates the conditions of Alan Greenspan's irrational exuberance environment, where investor overconfidence pumps the market up to the point where a huge correction is only inevitable. When the stock price keeps going higher, it creates FOMO trading, or fear of missing out. More and more people try getting in at higher prices thinking that the price is only going to get even higher. The stock then makes a parabolic move higher where it becomes unsustainable, then a major collapse happens. This has happened time immemorial. It always happens in a formal environment where people are afraid of missing out and they put in all their money into the market or into a stock, and it causes the stock price to go even higher, thinking that people are missing out on the action and on the profit, so they invest more money. And when they do this, it creates an unsustainable price and an overvaluation of a stock where it is completely unsustainable, and it brings down the stock price even further by it crashing. This type of trading affects so many traders that they don't even realize it because they all want to make money. Investors often get intoxicated with their gains in a bull market and tend to not book profits and never take anything off the table. Remember that both bulls and bears make money, but pigs get slaughtered. So these are the 3 psychological mistakes that you should avoid, that I came up with, and a lot of other investors have used in the past. And I think that if you avoid these 3 psychological emotions, I think that you will come more ahead than other people in the market right now. If you found this information useful, please give it a thumbs up and please subscribe to my channel. I have a goal of reaching 100 subscribers before the year end. If you could do that, I would greatly appreciate it. It won't cost you anything, but it would help me out tremendously. Thanks for watching, and I'll see you in the next video.